At the end of May, markets were focused on two main areas of concern. The first was around monetary policy. Would the Federal Reserve in the US be able to cut rates enough to satisfy some fairly aggressive market expectations? And second, would trade concerns really begin to impact on global growth? As we reach the end of June, we've had some reassurance on both counts. Firstly, on monetary policy, we've seen both the Fed and the ECB indicate that they would be willing to reduce interest rates and loosen policy as needed. That seemed to be enough to satisfy financial markets. And secondly, on trade policy, we've seen a ratcheting down of the rhetoric following the G20 summit, and the signs now are that we could begin to see some progress between the US and China. So after a fairly strong performance from equities in June, the question is what next? When we think about interest rate policy, we've seen some positive rhetoric from the Fed and the ECB, but no interest rate cuts. The concern here is that the central banks don't move quite as far or as fast as markets currently expect. As for trade, the rhetoric and the news flow have been a bit more positive recently, but we've been here before, and we know that it doesn't take much, some changes in commentary, perhaps a change to tariffs, for the outlook to become a little bit more negative. And then the other issue to focus on now is really growth. The global growth environment has been a little bit weaker recently, and that's partly underpinned the commentary from the Fed and the ECB in terms of lowering interest rates. But the danger here is if we see that growth outlook deteriorate, investors will start to think a little bit more about corporate profitability and the potential impact on earnings growth. We've had a strong performance from financial markets in June, but we continue to focus on some of the risks that we see. One area of attention is really around market liquidity. We've had a few examples in the past couple of weeks, including one where a fund was unable to return cash to its investors when they asked for it. It's an important reminder, we think, to focus on the broad range of risks when investing, including the possibility that you won't be able to get your money back for a period of time, or at a price that you like in a more difficult market environment. When times are good, it's relatively easy to buy and sell assets. But when things get a little bit tougher, some of that market liquidity can disappear quite quickly. At MoneyFarm, we continue to believe that the right course of action for most people is to invest in broadly diversified, low-cost, liquid public market exposure. And that's what we aim to provide.